Good afternoon, everyone. Good afternoon. Good afternoon. We about to get it kicked off real nice and decent today. Good afternoon. Good afternoon. Good afternoon. So we're going to let a couple more people get in here and we're going to get into this real nice and decent today. So we're going to let a few more people get in here. And then we're going to go ahead and get started. So we're going to give it about, a couple minutes here. And then we're going to run through this thing. How you doing, Bree Bree? Nice to see you. Nice to see you. So, I have definitely reviewed the annual filing for the Tulsa Real Estate Fund. I have definitely done that. So we are going to spend some time today. We are definitely going to spend some time today. Credit is tomorrow. That's tomorrow. Tomorrow's Sunday. This is we just covering the Tulsa Real Estate Fund today. And their latest annual filing. All right. So we got a few people in here right now. So we're gonna go ahead and get this started, right? Let's go ahead and get this started because I'm gonna be saving this anyway, right? So I would ask that hold your questions till the end. But if you have any questions, feel free to use the bottom left-hand icon with the question mark and ask your questions there. And I will be happy to get to your questions as I can. I'm going to get to them, and I'm trying to leave a little time to get to questions at the end. Now, right? So this is another discussion on hashtag getting real woke. Today, right, we are going to break down the annual filing for the Tulsa Real Estate Fund that was just released to the SEC yesterday. Let's have us a discussion. Now, I want you to know that I've reviewed this filing, and it ain't looking good for the Tulsa Real Estate Fund investors. I'm gonna just keep it a whole buck with you. It ain't looking good. So now, before we get all the way into the numbers and everything, I want to cover some definitions because I think definitions are going to be very important as we move through this discussion, right? So the first thing I want to talk about is fiduciary obligation. What is a fiduciary obligation, right? What is the definition of a fiduciary, right? So the Tulsa Real Estate Fund manager, Tulsa Legacy Founders, LLC, or whatever they're called, right? The company that J. Morrison incorporated to manage the funds on behalf of the Tulsa Real Estate Fund is what's considered a fiduciary. They have fiduciary responsibility to the investors. And what is a fiduciary? An investment fiduciary, and I'm going to read this directly so that way there is no misapprehension on this. I'm going to read this directly from Investopedia, right? So I'm reading it directly from the source, right? While it may seem as if an investment fiduciary would be a financial professional, money manager, banker, and so on, an investment fiduciary is any person who has the legal responsibility for managing somebody else's money, which is what Jay Morrison is doing, right? So he has a fiduciary obligation, and this is very important to understand because the SEC, people like Jay Morrison think they're slick. He registered as a tier 2 crowd fund and used an exemption. But what he fails to realize is that the SEC is very clear, and I'll read it to you right here. I'm going to share it with you. We're going to read it together. This is from the SEC. Most private fund managers, regardless of whether they are registered with the SEC or not, have a fiduciary duty to their clients under the Investment Advisor Act of 1940. So Jay Morrison, even though he didn't register as an investment advisor with the United States Securities and Exchange Commission, even though he didn't take the Series 65 examination to be qualified as an investment advisor under the Investment Advisor Act of 1940, the Security and Exchange Commission still considers him a fiduciary because he is a money manager. And because of that, he has certain obligations and duties and responsibilities as a fiduciary. Interestingly enough, the Security and Exchange Commission, right, actually put out a nice disclosure and guidance on what it means to be a fiduciary and how they feel about fiduciaries, right? So I'll be happy to share that with anybody who would like to take the time to read that, but it is very clear. I will give you the Cliff Notes. 1, they have a duty of care. The duty of care of fund managers includes, among other things, the duty to perform adequate due diligence on the fund's investments, the duty to manage the fund's investments in the best interest of the fund, which we're going to get to shortly, and the duty to carefully monitor the fund's investments throughout the term of the fund. They have a duty to loyalty. And there's a long discussion on the duty of loyalty. But let's talk about one specific thing. Conflicts of interest that arise during the term of the fund are tricky, since a fund does not allow investors to vote with their feet by withdrawing during the term of the fund. Those conflicts must be eliminated or mitigated in a way that meets the manager's fiduciary duty. Now, let's remember that we discussed Mr. Morrison's offering circular, what he put out when he first started raising funds, his investment memorandum, or what they consider a prospective or a private placement memorandum, however you want to call it. Remember, there was a discussion on conflicts of interest, right? And let's look at that discussion that he had on conflicts of interest. It says, our manager does not have authority to invest the company's funds in other entities in which our manager or an affiliate has an interest. That is very, very important when you look at the filing that they just filed yesterday. When we get into that, you'll see some very, very, very questionable practices based on what he disclosed in his investment memorandum initially. Now, one of the other definitions that we need to cover here is what it means. So when you look at an investment, we need to talk about certain things, right? So we're going to talk about gauging the return of an investment versus another investment. And so one of the things that we want to talk about here is opportunity cost, right? So what is opportunity cost? And I want to cover this because when I get into these numbers, you need a firm grasp of some definitions, right? So opportunity cost, again, right? I'm going to read it right from Investopedia, right? So that way, you know, I'm not making it up. I'm not spinning it. It's very simple. Opportunity cost represents the potential benefit an individual, investor, or business misses out on when choosing one alternative or another, right? So for example, I'll give you a good example of what opportunity cost looks like. So let's say you invested in the Tulsa real estate fund at 8%, but you could have gotten 10% in an index fund, right, at minimum. So you lose the opportunity cost of 2%. This is money that you could have made by investing in a better investment, right? So you always have to count your opportunity cost. So I want you to understand the definition of opportunity cost. When I run through these numbers, you're going to understand why. Now, in a previous video, the initial video I talked about with the Tulsa Real Estate Fund, when I first started breaking things down before this annual filing came out, I talked about inflation and taxes. So I would recommend that people go back and watch that video if you have not, to understand inflation and taxes and how that affects your adjusted rate of return, right? Now, the other thing I need to explain to you that I want you to understand is what's called pro rata. What you hear a lot when you invest in a fund is what's called a pro rata distribution, right? And you have to understand what pro rata means. So again, I'm going to give you the definition directly from Investopedia because I don't want you to think I'm spinning it, right? So I want to keep it all the way live with this one, right? Pro rata. Pro rata is the Latin term used to describe a proportionate allocation. It essentially translates to in proportion, which means a process where whatever is being allocated is being distributed in equal portions. Okay. So what does that mean, right? So basically, if you invest $1,000 into something and there's tons of people who have invested $1,000 and you've raised, the total fund has, let's say, $10 million and you get 8% of $10 million, that's not to say that 8% of $10 million means you're going to get $800,000 when you only invested $1,000. You're going to get a pro rata distribution based on your investment. So 8% of $1,000, right, essentially is $80. So you would get an $80 return on your investment. It's pro rata to your investment. And pro rata understandings are very important when we get it. Boy, when we get into these numbers right here, it's going to be some hate feelings. Hate. But that's okay. Now that we've done that, let's look at what the numbers are, right? Let's get into numbers. I like numbers because men lie, women lie, but the numbers don't lie, right? So let's get into this. Now, I want you to understand that if you remember, right, if you have watched my previous video, I talked about what would happen, right, if when they offered you an 8% dividend, right? I explained to you how inflation and taxes plays into that. So when you really look at it, your adjusted rate of return was only 3.8%, right? And this is horrible for the amount of risk. Well, I neglected to add something, and the reason why I didn't add it in is because, of course, I wanted to wait for the annual filing to come out because, as I suspected would happen, the management fee would go up, so I wanted the most current numbers to account for the management fee as well. Per the new annual filing, the management fee is 5.5%. What does that mean? That means that when you, I know that is funny, right? So what that means is that when you invest your money in the Tulsa Real Estate Fund, regardless of whether they make money or not, regardless of whether they do anything or not, for as long as that money is sitting in the fund, you have to pay essentially J. Morrison a 5.5% management fee. Now wait, it gets better. If you are starting at an 8% dividend and you calculate the inflation and you calculate the taxes, you're at 3.8% because the average person is going to fall into a 15% tax rate per the IRS. Now wait, check this out. Once you calculate the management fee in, because remember, you have to take the management fee out of your rate of return. What you're really looking at is a rate of return after inflation, after taxes, after the management fee. Your true rate of return before anything happens is negative 1.70%. You lose even if you get the dividend. It doesn't matter. The dividend has no weight in this situation because even if he pays you 8%, by the time you count inflation, taxes, and the management fee, you have still lost money. This is no longer an investment. This is a donation that costs you money every single year. That's what this is. These are the facts. Now, let's even make it worse, right? Because it gets worse. How about the fact that he has not paid a dividend yet? He has yet to pay a dividend, which means that you have not seen the targeted 8% dividend. So now you are losing 8% because you're not getting paid the dividend, and you're still paying the 5.5% management fee. So your true loss every year is 13.5%. And you have to calculate the 2% that you are losing in opportunity cost because you could have made a minimum of 10% in an index fund. So because you didn't invest in an index fund who could have made you 10%, what essentially happens is you lost 2% for investing in Jay Morrison's concept of buying the block back. So now when you calculate the fact that you didn't get the 8%, the fact that there's a 5.5% management fee still, and you calculate the loss of the 2% in opportunity cost, your real net loss looks like 15.5%. And you haven't made a dime yet. You cannot make money in this situation. It is impossible to make money. 8% does not cover the losses. It does not cover the taxes. It does not cover the inflation. It does not cover the management fee. 8% does not perform. You lose. And here's the worst part. A 5.5% management fee is not standard on Wall Street. No one charges 5.5% and a 50% profit on any money made. No one on Wall Street does that. The maximum is a 2% management fee and a 20% performance allocation, or 20% of the money made from the investments. That is it. The fact of the matter is most funds don't even charge a 2 and 20 structure anymore because institutional investors aren't going for it. So most funds now are charging 1%, 1.5%. And more than that, outside of that, not only do they charge less, but they have clawback rates and hurdle rates, which says that if they don't make money on your money, they can't charge you the management fee. They only get the management fee when they make money. If they've already made a management fee and they lose money, they have to give the management fee back. There are all these different things that are laid out for funds that are best practices and industry standards that are not being followed here. So, okay, let's walk into this even further. Now, on top of the management fee, the interest rate, the management fee, the inflation, is right. So on top of the management fee, the inflation, and he charges the fund a 1% acquisition fee for every piece of property. Let's walk into that and see what that really means for the investor, right? So if he buys $1 million property and he charges the fund 1%, so if he buys $1 million property, right, he charges the fund 1%. What that really means on $1 million property, 1% looks like $10,000. But remember, you have to remember that the fund, right, does not see that until the property is sold. And if he buys $1 million property and he charges you $10,000 and he only sells the property for $1 million, well, there's no profit. So that's all loss. But wait, what if he buys $1 million property and he sells it for $1.1 million? There's a $100,000 profit there, right? So now look at this. He invested $1 million into a property. He sold for $1.1 million. The profit to the investors is only $100,000, right? So the profit to the investors is only $100,000. This is where it gets interesting, because if he charged 1% on acquisition and that's $10,000. If profit on the sale is only 100 because he sold it for 1.1 million, that means the true cost to the investor is 10%, not 1%. You see how that works? It's 1% on acquisition, but because the investor doesn't realize anything till there's a profit, right? Because the investor doesn't realize anything till there is a profit, right? That 1% acquisition fee, if he sells it for $1.1 million, is really a 10% cost to the fund. So you get a pro rata hit of 10%. Now, let's go into this a little bit further, right? So we really need to dig into this a little bit further. And so now we're going to go into the filing. We like filings, right? So we're going to get into this filing now. So here we go. So we are at the Tulsa real estate filing, the annual filing. This is the annual filing here, ladies and gentlemen. Here is the annual filing, right? So we're going to go through this a little bit, right? And we're going to get all the way into this and we're going to make it real fun. Now, here we go. So we're going to start, right? Now that we have an understanding of the cost, the breakdown and everything and what this really looks like to investors, now we're going to get into some stuff, right? So now we're going to start on page 20, right? Because I like to just cut through the minutia and cut through the fluff statements and get to the real facts, right? So let's get into page 20, right? So on page 20, right, here we go, right? So we have a results from operations statement, right? And we have some recent developments. So let's get into recent developments. Let's see here. So there has already been a default on a property. So let's look at that. Let's read that together. On March 27, 2020, we sold a property located at 1000 Carteret Road, whatever, Bridgewater, New Jersey, for the purchase for $26,000, less the original cost, plus improvements. The loss on the sale was $55,918. So he's investing your money to lose it. There was a default and a foreclosure on property, right? So what this tells me is he has no concept of how to manage money in real estate investments. But let's go further. Let's just get to page 21, right? You see that right there? That is a net loss. The fund has lost $1,018,992. That's what's happening. So he's losing money. He's lost over $1 million of investor money so far. So let's look at the numbers of this, right? So how does this affect the investor? So what that really means is that your investment value at this point, if you invested $1,000 and he's lost $1 million, let's say he's got $10 million total of other people's money. So let's say he's got $10 million total of other people's money, right? So let's look at that. $10 million of other people's money. Give me a second, guys. Okay, let's have $10 million of money in the Tulsa real estate fund, right? And let's say that now he's lost, we'll just call it a nice round number of $1 million. That means he's lost 10% of the invested money that people have put in. He's lost 10% of the fund's money. So what does that mean? So that means that you haven't gotten your 8% dividend. There's a 5.5% management fee and a 2% loss in opportunity cost. You are already negative 15.5% in ROI on the year. And now he's lost another 10% of your money. Your total loss on the year for 2019 is 25.5%. You have lost 25.5% of your investment value. So not only he's still paying himself, that's the 5%, that's the 5.5% management fee. Of course he's still getting paid. He gets paid whether he makes money or not. That's in the agreement. Of course he's getting paid. So really, you're losing 25.5% of your money at this point. So for 2019, your losses are 25.5% so far. We're not done yet. We're not done yet. Right? So let's move to page 31. Page 31 is really interesting as well, right? So when we get to page 31, right, what we see is that there is an intercompany marketing services agreement. So essentially what he's doing is he's paying himself through and the J. Morrison Academy marketing fees from the company. But wait, hold on. If we go back to the conflicts of interest in his perspective, our manager does not have the authority to invest the company's funds in other interests in which our manager or an affiliate has interest. So if he's paying the J. Morrison Academy management fees for marketing services, right, then what is that? He's investing the Tulsa real estate fund's money into paying an affiliated entity for marketing. That is in direct conflict with what he stated in his offering memorandum. I'm confused. Make it make sense. Now, let's go a little bit further. So now if we go to page 35, right? Oh, this is going to hurt some feelings right here. We can go to page 35. Let me highlight this so we make sure we don't miss it, right? Page 35. Check this out. Page 35. I got to highlight it. It says rental income. Let's slide that over. $3,000. $3,000 for the whole year. So that legacy center, that black house, has only generated $3,000 for the entire year of 2019 in rent. The projected rent for this, according to J. Morrison's statement, right, was $426,826 a year. So that means that if you only receive $3,000 in rental income for the fund on the Tulsa Legacy Center, the Black House, whatever the hell you want to call it, buddy, you are about $422,826 short. Make it make sense. So what that means is, wait. He's $422,826 short of what he was supposed to be making on that building based on his projections. Now wait, what does that mean for the investor? Oh, that's very important because that's exactly what it is. The red house. So wait. So let me tell you what this really means for the investor, right? Let's get into this. So the reality of the situation is, for the fund, this would have represented a growth or investment rate of return. This would have been a return on your investment because it's investment income that would have come into the fund. If you have $10 million in assets under management, what we're talking about, if you lost out on $422,826 in rent, you lost 4.2% in growth. That's 4.2% that did not come to the fund. So what that means is, if based on his agreement, it's a 50-50 split, right? What we're talking about here is that the fund investors are negative another 2.1%. So not only has he lost 10%, Not only is he charging you a 5.5% management fee, not only is there inflation and taxes, right? By the time you count it all told, you're at 27.1% loss on your investment for 2019. That's where we're at here. This is a horrible investment. It's a horrible investment. And there are more losses coming because there's still assets that he's bought, that he's holding, that haven't been disposed of yet. They haven't been sold yet. So there are more losses to become. And so the reality of the situation is this is actually going to be worse as the year progresses. Now, let me give you a real number. I'm going to give you a very, very real number back on page 21, right? So when we go back to page 21, right, this is what his performance looks like in a percentage basis, right? This is what it is. And I'm going to show it to you so you can read it, right? Here we go. Net losses. As a result of the cumulative effect of the factors described above, our net loss is $834,700 or 552.98% to $1,018,992 for the year ended December 31, 2019, up from $184,000. He's increased losses by over 500%. He lost money in 2018. He's lost money in 2019. If he keeps losing at the rate he's losing, the fund will be out of business by the end of next year, but he'll be in prison before then. Every investor needs to get their money out as fast as possible. He has no concept of what he's doing. None whatsoever. So let's recap this. Even if he does nothing, he gets a 5.5% interest management fee. He has told you guys he's going to give you an 8% dividend. Even if he paid that 8% dividend, with a 5% management fee, inflation and taxes, you still would lose negative 1.70%. You'd still be at a loss of 1.70% even if he paid the interest. Moreover, because he hasn't paid the interest, once you calculate the 8% you're not getting, the 5.5% management fee, and the 2% opportunity cost loss, and the fact that you could have gotten, right, 10% in an index fund, but you sacrifice 2% to invest in this, right? You lose that 2%. Your total loss is 15.5% before he even makes an investment. You lose before an investment is made. This is a shit show is what this is. And I'm tight. I'm tight. Because this hurts the community. It cannot be a long-term investment when even at a standard rate of 8%, even if he paid it, that 8% represents a negative 1.70 rate of return. You lose even if you get the 8% after you count inflation, taxes, and the management fee. The average person falls into a 15% tax rate. There's a 3% inflation rate. There's a 5.5% management fee. He gets paid his management fee whether he makes money, invests the money, or does nothing but sits there. He could sit there for the whole year and do nothing and still get paid 5.5%. So let's be very clear. Let's go to page 44 and 48 and 49. So let's go to page 44. Let's look at this, right? Page 44. Let's see. So how about, right? hold on a second. Let me get down the page. Let me get down because this is better outlined in page 48 and 49. Give me a second, guys. So 48 and 49, here we are. More about the intercompany marketing agreement. Here's what you note though, right? During the period of January 1st, 2020 to March 31st, 2020, the company paid marketing expenses of $63,150. So the Tulsa Real Estate Fund paid $63,150 for marketing fees, of which $31,575 was paid on behalf of JMA, J. Morrison Academy, as partial satisfaction of the company's reimbursement obligation to JMA under the Intercompany Marketing Services Agreement. JMA did not reimburse the company for 50% of the payments made by the company for the period from November 1st, 2019 through March 31st, 2020 of $111,250. However, on July 1st, 2020, the company entered into a letter agreement with JMA pursuant to which JMA has accepted $55,625. So what you're telling me is you still owe the fund money, but you trying to get money out of the fund for money that you claiming they owe you when this should have been a wash. How does that work? How does it work? How? I'm confused. I'm very, very, very confused about how this works. So I wanted to get into this and really break this down because I need people to really understand what's happening here, what the numbers really look like. Because this is a disaster. It's a disaster. This is terrible. And the worst part is the J. Morrison Academy, according to this filing, right, has signed a lease agreement with the Tulsa Real Estate Fund in the Legacy Center, and he hasn't made a rent payment yet. The document states that it has been deferred because of COVID. Make it make sense. Make it make sense, guys. Make it make sense. He hasn't even paid rent for the space he's got in the Tulsa Real Estate Fund. I mean, in the Legacy Center. It makes no sense. This is really, really bad. I was waiting for this file to come out so I could break this down because I knew this was going to be terrible. So listen, guys, at this point, I'm taking questions. I've broken this down all the way to the ground. Now, I didn't get into like their scandalous accounting practices that are barely legal under US GAAP and under FASB, and how they're accounting for assets, but that's very complicated. That part is very complicated and very, you got to have some technical knowledge about accounting to understand that. But just based on what I did break down, this quick overview that I provided, you can clearly see that this is a disaster. So if anybody has a question at this point, I'm taking questions. Anybody got any questions? I'm taking them. Please use the question mark area in the bottom left-hand corner. Yes, the SEC can and is, I'm telling you, this is going to go bad. Yes, there is a lot that's going to happen here. He's violated his fiduciary He's definitely violated his fiduciary obligation, number one. Number two, he's not managing this, he's not managing this fund right at all. There's conflict of interest so he's violated assurances that he gave the investors. There's a lot here. This fund won't be around much longer, and I hope they shut it down sooner than later, because the fact of the matter is, at this rate, there won't be anything to recover if he is allowed to operate too much longer. You know what I mean? If he's allowed to operate too much longer, you know what I mean? There won't be much to recover. So I'm going to take some questions now. Let's see here what we got. Is there anything that he's done illegal yet? So I just answered that one. So let's see what else we got here. Can they make him pay back investors if convicted? So yes, he would get a restitution order. He would be subject to a restitution order for the difference between what they can recover once they shut him down versus what's still outstanding to the investors. So yes, it's called a restitution order. And there's no if about conviction. It's a matter of when now. Okay, let's see. What else we got here? Let me see here. What if you want to do the opposite of what he did with the money? How do you start? Okay, I love that question. Unfortunately, I'm very careful with answering questions like that. And I'm not saying that you would do this, and I'm not saying that anybody in this group would do this, but I never want to encourage the next fraud by teaching a concept that would allow them to do something that would hurt this community. So I'm very, 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 very careful about discussing how to go about capital raising, how to raise funds, how to structure funds, things like that. I'm very, very cautious with who I discuss that kind of information with. That's not something that I would be willing to do in an open forum like this, and that's just me being honest. What else? The lawsuit Tony filed at this point, would he even be able to collect the $500K he sued for? Highly unlikely. Highly unlikely. Because the fact of the matter is, he's going after more than likely Jay Morrison personally, or the Jay Morrison Academy, or an amalgamation of the two. And the fact of the matter is, Jay Morrison will just file bankruptcy and go under bankruptcy protection, and it'd be very difficult to collect at that point. So it's going to cost him more than it's worth. I mean, even if he got a civil judgment, I guess the best thing he could do is file a writ of attachment and attach it to Jay Morrison's personal Social Security number and garnish wages. But it's kind of hard to garnish wages of someone who's not really a W-2 employee. Does that make sense? So that's kind of that. Based on what I've seen and what I know, it looks like about 30 years it would be the minimum. But okay, who's the worst scam? Whose worst scam is more clever, Umar or Jay? Scam is scam, fraud is fraud. I don't weight one against the other. Like, it all hurts the community at the end of the day. So that's just that. Let's see. Can the SEC prevent him from raising more funds? So what they'll do is, when they get ready to So what will happen is, when they get ready to bring civil action against him... Give me a second, guys. Okay. So what will happen is, when they get ready to bring civil action against him, what they'll do is likely file an injunction to bar him from being able to raise any more funds, and then they'll put freeze on the account. And then they'll do an asset seizure. So that's 9 times out of 10 what happens. Okay, so let's see. Let's get to another question here. So, is it legal or not? Okay, so there are aspects of this that are illegal. There are aspects of his past that are definitely 100% illegal. So there are aspects of his past that are definitely 100% illegal. So the reality of the situation is, at the end of the day, right, he's going to get hit he's going to get hit for not only what happened in the Tulsa real estate, but what happened in his past as well. It's going to be a collective situation. So yeah, rest assured, he's going to prison. Okay, let's see. What else we got here? What if he has different accounts under different LLCs? And that doesn't really matter because it's all tied to the same situation, the same fraud, the same, it's all tied to the same fraud. So they'll follow the money into the different accounts. And if that money came from the Tulsa real estate fund, then what will happen is they'll go after all of that money. Does that make sense? So they'll go after it wherever it's at. Let's be very clear about that. Okay. Let's see. Give me a second, guys. Trying to open up the Q&A thing again. Give me a second. It's not, for some reason, it doesn't want to open now. Okay, so the Q&A is not opening for some reason. So just go ahead and flood the channel with your questions, and I'll answer them there. If you just want to post questions in the comment box, that's fine, because the question box seems to not want to open for some reason at this point. It has an attitude. So, the net effect is this is what it is. This is where we're at. I'm definitely going to save this. I'm sorry that it was breaking up a little bit. My phone kind of got a little hot, so I think that's kind of what the problem was. But I definitely tried to cover everything enough times to make sure everybody got the information. And I hope this was helpful for everyone. I hope this breakdown of the situation was very, very, very helpful. If you have any additional questions regarding this, please feel free to reach out to me in my DM. As always, people about me, like it, like my videos, subscribe to my YouTube channel, follow me, all of that great stuff. You know what I mean? If y'all do that, the more people y'all tell about me, the more information I can put out to the more people, the more helpful this is for people. You know what I mean? I'm trying to help people as much as I can. I'm trying to get to that magic 10,000 number on Instagram, so y'all help me do that. That's cool. If y'all help me to get to that magic 10,000 number, that'd be helpful too. You know what I mean? So let's get there. Let's like, let's subscribe, let's follow, let's do that. Tell your people about me. You know what I mean? Let's get out here. Let's get it done. So that way, you know what I mean, I can put this information out, get it to more people, and help people protect themselves from nonsense like this. All right, y'all. Again, if you want to reach out to me via DM. I'll get back to you as soon as I can. Any questions, comments, concerns that you have, feel free to reach out. It was good talking to y'all, and I hope the information was helpful. Y'all have a great day.